What you're watching is the violence in market. If they raise interest rates, basically they go bankrupt.
I think the carry trade, it just got over way too carried away.
The reality is that they can't really raise them that high without killing the bond market. To do this for so long without any consequences was largely because the rest of the world was also lowering interest rates.
Here's the hard part with Japan. There's so much value in Japan.
Now that's flipped. The US started raising rates and Japan's like, what the fuck? Why are you guys raising rates?
Japanese yen. What are the short-term or long-term ramifications of the unwinding of the yen carry trade? And could we see a similar global market sell-off if Bank of Japan raises their rates again? That's from Mario. Does blow up of yen carry trade take the wind out of sails re the Japan theme? That's from Patrick. And I see a couple of other members have raised the Japan theme.
We still like Japan.
I think the carry trade, it just got over way too carried away. If you look at dollar yen, people got too stretched in that trade, too much leverage involved. Now, in terms of Japan, here's the hard part with Japan. There's so much value in Japan. Where do you start? The other trick with Japan is it tends to be more stock specific. As opposed to sort of like sector specific. There's a lot of industrial companies in Japan, and each they have own individual drivers. Quite a different situation than in the US or Europe. I guess our starting point is the ETF, but that doesn't mean to say you can't find great value in some industrial companies in Japan. But if we start picking those, it'd be sort of more stock specific things. The reason why they haven't found their way into dividend portfolios, dividends don't tend to be very high in Japan. Maybe they start paying out more earnings as dividends because they've got a lot of cash on their balance sheets, being these companies. So yeah, Will, hopefully that's addressed your question there. It's we're just perplexed in terms of which way to turn in terms of what to buy in Japan. So we've just gone to the overall ETF. This is the Nikkei, and this is the Nikkei versus the S&P in US dollar terms. Underperforming, I think back in 2012, it's been a massive bear market from a relative perspective. So that's our thinking on Japan. Look at that sell-off. That was crazy, eh? All right.
Violent. Shall we move on? Chris, do you have anything to add?
Only in that what you're watching is the violence in markets and the volatility that we're going to get, I think, on a go-forward basis when you have the collapse of any debt-based system. And that we're kind of watching that. So debt is credit, right? You've got all these credits out there. Like if you go back and you think about what's the trade that we were doing with Japan, well, firstly we had low valuations, but secondly you've got this weird setup where there's a ton of money that's sitting in Japanese government bonds for a whole host of different reasons, massively overvalued, very precarious situation in that they were literally 80 basis points away from bankruptcy if they raise rates that high. Ultimately at some point they will be forced to default or raise rates, and which brings them to a default. And then the question is, where do you hide? We think that it's better to hide in actual physical companies that are producing goods and services that are also simultaneously cheap. Just because that unwinds for a short period of time doesn't change those underlying fundamentals. And that's not just Japan, by the way, that's largely the Western world. Path towards that is never going to be straight. In fact, it's likely to get even more volatile. Again, it comes back to what I think was our first question. How are you going to manage the volatility? And that's to be position sizing, could be just your mental psyche, whatever. But when I look at Japan, here's the basic. If they raise interest rates past, I think it's 80 bips, basically they go bankrupt. So that's what traders are looking at. They're going, well, they can't really raise that high. So, they raised about 25 bips, and that was enough to have a lot of those leveraged players go, oh shit, we didn't think that was going to happen. Wow, we're going to unwind that trade. The reality is that they can't really raise them that high without killing the bond market. And then you go, okay, well, what happens then? Well, then capital goes into hard assets. It goes into equities as opposed to debt. So nothing's really changed. They scared the shit out of the market because the market was sitting there going, well, you guys can't raise rates. We know you can't. You're fucked. Are we just going to go long equities and essentially short the yen? And there's a lot of other interplay, right? Part of the reason that Japan managed to do this for so long without any consequences was largely because the rest of the world was also lowering interest rates. We had this long boom in bonds, right? Bonds kept going up, interest rates kept going down everywhere. Now that's flipped. The US started raising rates and Japan's like, what the fuck? Why are you guys raising rates? Like, this is hurting us. We can't raise rates. We can't follow you. We go bankrupt. And so traders looked at that and gone, hey, this is great. These guys can't raise rates. We'll just borrow yen. Rates are low anyway because they're trying to hold this ball of wax together. We'll borrow yen and we'll go invest it. We can just put in bloody treasury bills and they're in a probably 5-ish% spread, almost risk-free money. The only problem you're looking at is volatility of the currency. People got more accustomed to that, more leveraged, and then of course they did their little 25 pip move, which really theoretically you'd think wouldn't matter, but it matters when you got leverage. And so people were like, wow, we never thought you'd do that, unwind. But the point is that can only go so far. This is kind of noise in the grand scheme of a debt cycle that's in a collapse mode. And in any collapse of a debt cycle, you actually want to be long assets. You'd much rather be long equities than you would be in anything debt-based.